Well, welcome everybody. Can you hear me? Good. I'm not sure we necessarily need these microphones in such a good acoustics, good room. My name is Bob O'Keefe. I'm Dean of the Faculty of Management and Economics, and welcome to the Credit Crisis 5 Years On panel debate. This is one of a number of events we run for both alumni and students. So at the moment, those of you students will know that we are in a series of events related to careers, and particularly with this week, with a focus on finance, banking, etc. So a number of events have been running all over campus, so this feeds into those events. But this is also an event for some of our alumni and others to come along and engage back with the school and say hello to us. So all I'm going to do is essentially introduce the panel members and then kick things off. So the panel members will speak for 10 minutes or so each, and then we will open it up to questions from the audience and in between the chat panels. So let me introduce the panel members. On the far right, starting at the right, Mr. Eric Versavel says here, country manager, CEO at ING Bank in the Ukraine, previously holding the same position in Korea and China. So Eric works for ING, Deutsche investment and retail bank, yes, one of the major European banks. Moving in the middle, David Burke, as some of you know. David is one of our alumni with a degree in music and management, and David is a finance director and general manager at the London Philharmonic Orchestra. Previously worked at the English National Opera. So David is responsible for running, you're a charity, are you?
Yep.
Running a charity in the cultural and arts area, and he's going to talk a little bit about how the credit crisis has affected that. And then on my right here, Sean Taylor is one of our geography graduates. Sean's director of private wealth management at Deutsche Bank. Started his professional career in the army and has held positions at Goldman Sachs and UBS. So I'm not going to say much more. I will say, however, that one of the interesting things about the credit crisis is it's still in the news. So not only do we have what's happening in Greece and the Mediterranean, I think yesterday there was a report came out which made it, certainly on the BBC website and other news feeds, about employment in the city, suggesting that I think the number of people working in and around financial services in the city had declined by about 100,000. So there is still a felt impact in terms of affordability. So thank you, gentlemen, for joining us. Who would like to go first? Who would like to go?
I'll go first.
You'll go first. Thank you, Dave.
So as Bob said, I'm the finance director and general manager at the London Philharmonic Orchestra. There are many, many things that I could talk about running a world-leading orchestra and the peculiarities and eccentricities of it. But I guess the key thing for today is that I'm a finance director. I'm a finance director of a £10 million company that happens to be a charity. And a lot of the challenges that we've faced over the last few years are similar to every company in the UK and globally, many globally. And a lot of the processes that we put in place to try and overcome those are similar to what has gone on in many different organisations. So I'll try and talk from that sort of background. However, saying that, there's a couple of contextual things I just thought I'd mention about the LPO so you can understand where the decisions we made came from. So the first one is a charity. So having built up our reserves, our aim each year is to break even. So we're not looking to make profits, we're looking to raise as much money as we can, whether it's through earned income or through donations, and then spend as much of that as we can doing the charitable objectives, which are giving concerts, doing education work, releasing CDs, that sort of activities. Not all of our work, therefore, is profitable. We do 35 concerts a year at London in the Festival Hall. On average, they will lose £60,000 to £70,000 a concert. So we have to raise money to do the concerts. You have 100 elite musicians on stage, world-renowned soloists. It's an expensive business. The concert hall, by definition, is finite. We tend to sell at about 80% capacity, so 2,500 people, and the costs just don't match. So we have to raise money and do other activities to function against that. However, once we've done a concert in London and we've met all our pre-costs, so our rehearsals and the travel costs of getting the guest artists there and things like that, we can then sell them on. So our sort of model is we do our concerts in London, and then we will try and sell them on to promoters overseas or within the UK. We sell on our work to festivals, and also we do, as I say, commercial work such as recordings, soundtracks, and things which are profit-making, and that profit's ploughed back into our education work and our London concerts. So I guess what makes it slightly interesting is that we have lots of different key income streams. So we sell to the public, ticket sales, CDs. That makes up about 15% of our turnover. Our turnover is 10 million, which is convenient for maths. We deal with the government. 20% of our income is government grants. And then we deal with business, whether it's, as I say, with the promoters and festivals and overseas agents, where we're selling our product, our concerts, or whether it's through sponsorship and dealing with corporates and individuals who will sponsor the orchestra for commercial benefits, for hospitality, for entertaining, for branding with association. So there's lots of different avenues of how we generate money. I think of a lot of organisations where a very good balance. It splits into 5 tranches with government, and we have opera, which is sort of a special niche. And so when I was first approached to join the company, I was particularly attracted by that because it gives some sort of stability. Or so I thought 5 years ago. And it has helped us manage the various challenges that we've had over the last 5 years, the breadth of income streams. The fourth factor, just in terms of context, is that we're quite unusual in that we're a charity, but we're also a share limited company. We're owned by the players, so there are 80 players who own the company, and they're the regular players, but they're self-employed, and they get paid per 3-hour call. So if we decide not to do a concert, we don't have to pay anyone. So when we first looked, when the crisis first hit, the easy thing to do, you can cancel 3 concerts, you just saved £180,000. However, it's not our objectives, and if we were to reduce our performance, our number of engagements, the better artists would move on, and they would find other work with orchestras or companies that are willing to offer them full-time work, or the equivalent of full-time work. So we have, as well as trying to balance the books and get the money to work, we also have to provide enough sessions. We offer about 550 3-hour sessions a year through the various different types of work we do. So we have to keep the diary full for the players as well. It's sort of a second objective we have to keep an eye on. So I guess looking at what it's been like in the recession, I was trying to think of an analogy. The only thing I could think of is it's like running on a treadmill that's been kicked onto full speed with hurdles coming at you all the time that you have to overcome. And if I talk through sort of just some of the key points, when it first hit, we'd spent about 2 years working with a developer in Dubai who was planning to open a concert hall, the first concert hall in the Gulf. And we put 2 years' work in that. Our projections to have 3,000 or 4,000 net income from this every year. And obviously that just went through the window, just went out the window straight away and had gone. So that lost us 300,000 a year from our plans. The next year, some other smaller bits of corporate sponsorship fell away. However, we were quite lucky. Our 3 key sponsors, which one happens to be Deutsche Bank, had fixed 3 5-year agreements. And one of them has been supporting us for 29 years. And so as part of that, they all said, we understand where you're at. We will support you as much as we can. Not all arts organisations were in the same situation. Not all charities were in the same situation. So for the first 6 months, it wasn't quite so bad. But then we got hit by government cuts. We lost, and this was actually the time when I joined the orchestra, and the government cuts had hit the Arts Council, who are the quango that funds us, and they cut £600,000 off our income, which is a substantial amount. It's equivalent to 10 concerts when we only do 35 concerts. And that was a major shock. And that's when I joined. What had happened just before that, I think my predecessor saw this, but he hid from it. He sort of just managed to massage the figures. He managed to get some cash in advance for a few things. And so everything looked okay when he left. And I walked in and there was just a big hole that we had to sort out, which we did. But the government cuts have been quite a major impact. Then one of the ways we dealt with that is to reduce the number of performances in the UK and look for performances overseas. First of all, actually, we looked for performances in the UK, but the government cuts it all the regional venues. So we looked overseas. And that's sustained us for another couple of years. But obviously, that market is, we're going to the Canaries in January, and that will be the last time I expect that we'll do that tour for a few years. I don't think the money will be there for those sort of promotions. So that's sort of the key sort of facts of hitters over the period. So they're the hurdles that keep coming at us. As soon as we find one solution, there's something else, and there's something else. And it's been relatively constant. It wasn't just one big crash 5 years ago, and then we've been building from there. It's been a constant battle, and there will be more. We know that. So I guess what we did, as I said, when I arrived 3.5 years ago, we just found out about the government cuts. We just found out that actually we had about £1 million a year deficit, so that's 10% of turnover. The first thing, I just went through 3 simple stages. The first thing was just to find out exactly how bad the problem was. So, especially given that my predecessor had slightly been hiding it from people. So we had to literally start from scratch, rebudget, zero budget, every part of activity of the company. That's 70 different event codes, 7 different types of engagements, and each of those 70 different budgets, there's probably 35, 40 different budget lines. So we, first of all, make sure it's accurate. And then the second thing, we sat down with each of the budget holders individually and went through line by line, concert by concert, to see what we could take out. Sit down within admin, see what we could take out. Sit down within marketing, see where we could strip things back. And some of the things were straightforward. Little things, we have our season brochure. Went from being stapled to being, or not stapled, having a little arch, to being stapled, and that saved £15,000. There were some benefits that we were paying to players. If they came back from a concert, they weren't performing the next day, but they were travelling back, and they were back at 9 o'clock in the morning, we'd still pay them a full day's wage, knowing quite well most of them would go and get sessions in the afternoon. So that got pulled back to a half day's fee and things like that. So there was, in fact, I just printed out, this is the result of that was a list of potential options, a 2-page list, and this is effectively £1 million worth of savings. And we sat down as the heads of department. We then took it to the board, of which half of them were players, and said, this is a clear situation. We have to save this money. There is no option. We pushed income as well. We pushed the projections for ticket sales. We pushed the projections for development, but within realistic levels. And we said, these are the options. And we just went through line by line and see where the priorities were, what we really could not afford to go without, and what, in this sort of situation, could be saved. So the result of that were the players took 4% cuts. The staff were on salary standstill for 2 years. We reduced the number of concerts. We slightly reduced the number of rehearsals. We prioritised our education work from what we wanted to do to what we thought we could get funding to do, because there's a lot of funding out there, but people have slightly different priorities to where we were, and so on, and so on. But it was a constant communication, and I think that's the thing that I'm most proud of how we achieved it. We then meant, having decided amongst the board what was happening, what would be cut and what would be saved, we then sat down with all the staff and told them and explained again very clearly the situation. We showed them the budget, we showed them the projection if we carried on as we were, and the new projection, which was a balanced budget. We then sat down with 100, 150 players who were the core members of the orchestra and did exactly the same. Of course, some people had different priorities and some things were unpopular, but everyone could understand why we were doing it, and it was very, very clean and clear in that way. And as I said, and then we tried to find other sorts of work. The UK was the obvious first start, and then overseas. We've looked at new markets. We went to Dubai, obviously fell by the wayside, but we went to Oman. They just opened Opera House, and we went to there for the first time. We went to Moscow for the first time in a couple of years last year, and we're going back again next year. We've now started a relationship where we go to China every 2 years. We were hoping to go to Brazil next year. That's not quite sorted itself out, but probably the year after. So we're looking further afield. So we can still maintain those dates, we can still maintain those performances. It's a lot of work trying to ship 100 people, about £5 million worth of instruments to Moscow by road, armed guard, on the truck. It takes a lot of time. 100 visas, I'm sure you have visa issues yourself. Trying to sort out 100 visas, a lot more work involved, but that's where the markets are, that's where the opportunities are, so that's what we pursue. And then I guess the other story is sort of an internal story within that is sponsorship. So about £2 million of our income, 20% of our income, comes from fundraising. So it's not a direct payment for the services we provide. And that fits pretty equally from individuals, from trusts and foundations that have been set specifically to fund charitable objectives, and from corporates. And within that, that's an interesting sort of movement. So individuals has actually increased year on year for us. There's been a lot of publicity. The government has been putting a lot of weight behind high net worth individuals to donate to charities. We've actually worked behind the scenes as well. We've changed our board, we've changed our governance structure, so we can have a few more people of influence and strong networks that connected to the organisation. And that brought into the organisation who can then work through networks and make those introductions to try and meet new people. I was just saying we have one of the advisors to the economic advisor to the Kremlin's just joined the board, and she's talking about how she can bring in some of the Russian companies who are looking to list in the UK who want that sort of profile. So new different avenues of trying to get that sort of contacts, very entrepreneurial. Trusts and foundations at the start were in a mad panic because they live purely off investments, and obviously they went straight to the floor. Some of them took the philosophy that they would eat into their reserves to maintain their grants for a couple of years, and then have rectified. But now, 5 years on, they seem to have stabilised a lot. Some are giving less, some are winding up, but the situation seems to be a lot more stable than it was. And corporates is fascinating because they have our corporate income is about the same as it has been, but they are being a lot more demanding. Because it used to be CSR, corporate social responsibility, and those sort of things. Now it's more about return on investment. We're very lucky that Festival Hall is a beautiful venue, and we have a fantastic brand and reputation. So corporates are looking at coming in using the entertaining, the hospitality benefits, whereas before they were keen to fund our education work. Or if they want to fund our specific brand of education work, they want to know then what publicity they can get off the back of it. If we can have sponsor a player who will then come into the company so they can use them at various events of the company. So there's a lot more dialogue in it, which in itself is probably a good thing. What happened before, sometimes it was chairman's women, the chairman liked orchestras, or liked our orchestra, and so we put the money in. And then the company didn't necessarily make the benefits that we were offering and take advantage of them.
Or didn't know about them.
Or didn't know about them, perhaps. So now there's much more dialogue going on between the two. So I think in the long term, it's probably more constructive.
Okay. Very good.
Is that 10 minutes?
Good. Thank you very much, Deb. Sean, why don't we move on to you, because you're one of those corporate sponsors.
Right. Yeah.
Apparently.
I was waiting to get absolutely rinsed in that conversation, because I myself did not realise we were a sponsor until the other day when David and I spoke. Wow, who would have thought 20 years after staggering most of the time around this campus that I'd actually be sat in a professional school of management with a very good reputation talking about something that had happened in the 20 years which I may have been involved in. A bit worrying. I'm glad to see that all sharp implements have been left at the door, as the most popular online game right now is a Whack-A-Banker. Unfortunately, I'm one of those bankers. But working at Deutsche Bank, I'm able to turn around and say to you, I'm actually very boring. Finance, if you want to get on now, you've got to do things in a way which actually is very calm, very steady. People do not like bankers. I have clients who absolutely despise finance, but they are my clients because they trust me. They trust my team and they trust my bank. That trust has been irrevocably eroded since 2008. I'm what they call a lateral hire in finance. As you heard from a very kind introduction, and it's one of those ones where you always fear they're going to appear with an old lecturer's essay or report saying, you know, a village somewhere is being deprived of an idiot on the bottom of it. Yes, I'm a lateral hire. I left here and joined the army and became an army officer for 8 years. And I received a call that went something along the lines of, have you ever considered banking? Answer immediately was no, to be followed by, have you ever heard of Goldman Sachs? The reply of which was, Goldman who? I think everybody in this room will be able to say and talk quite at length about whether they believe that the vampire squid or their personal views on Goldman's are true. So going from Goldman's, I entered into what could only be described as a boot camp, and going from a boot camp at Goldman's for a couple of years, and then moved with my team across to UBS, where I spent a major part of my career in every type of derivative product, and hold the thought on derivative product that there possibly was in the market. I can remember when the first credit default swap paperwork was created at an exorbitant cost by Allen and Overy and Clifford Chance, and they thought they'd been really clever with a 17-page document, and that was in early 2002. By the time we got to 2005, that was down to an electronic 5-line documentation that was going through the system. My team went from trading one credit default swap a week, and we whooped and hollered and did jazz hands all around the office, to somewhere in the region of 500 a day. Okay, so you're getting some kind of scale. I have a personal belief, and I have to say at this stage, I caveat all my comments with that these are my personal views, not that expressed by Deutsche Bank and probably any of my previous employers, because my compliance officer will have my kneecaps for desk ornaments tomorrow morning if I don't say that. What happened? Well, I can trace the demise of $25 billion at UBS to 63 people. Now that's quite a major statistic. And that was because they thought they were really clever, greed got the better side of them. UBS created a hedge fund called Warburg Dillon Reed and completely rinsed the US market by selling unsuitable products to everybody that would buy it. Now, there is a two-way cycle here. You can only have a market when someone buys what you are selling. Now, there is an argument that people didn't know what they were buying, I think that was the case in some cases, but also, and I think many of you around the room are bright enough to realise that when someone waves a bag of gold coins in front of you, you'd like to grab it. Greed took over. We had a very good party between 2000 and 2008. We are now absolutely stinking hangovers. Probably like most of you on a Wednesday or Thursday, depending on whatever student night is these days. I found myself in 2008 in something which I really want to impress upon all of you that are thinking of coming into finance. I found that my value set, which had been developed over a number of years, including 3 absolutely glorious years here at Royal Holloway. Oh my God, they were glorious. That my value set that I hold very dear, which includes integrity, trust, teamwork, and basic just telling the truth and treating people with respect. I found that my value set was being challenged by the organisation that I worked in, and when they said, you know that letter telling them we've lost 12 billion, can you get them back and tell them we've lost 20? Because we actually didn't tell them the truth in the first place. It's absolutely unacceptable. Okay? So that was the impact of the credit crisis. Watching a firm in that stage of about 83,000 people, which UBS Investment Bank or UBS Group was a group at that stage. So I looked after Europe, Middle East and Africa for client origination and client relationship management for the investment bank. And I watched a firm, which I was very proud to be part of. You had the core values of trust, integrity and secrecy. Hold that thought on secrecy. Just implode, destroy itself. The only thing they didn't issue, because that was all going on that stage to Iraq and Afghanistan, was body armour to watch the knives that were getting stabbed in everyone's back. The firm destroyed itself within 6 months. And you're still seeing the destruction of 10,000 announced redundancies at UBS over the next 2 years. It's not a pretty landscape. Okay. So I made the personal decision to go into private wealth. I thought, this investment banking game, bit of a busted flush, better move on, and jumped into private wealth where in the last 2.5 years, my team, we now have a book of 650 million sterling, returning with 800 clients, private clients, and I hold an unholy trinity with 2 high street banks and a number of intermediaries to bring business. So what does that mean? Well, I've gone from the rather make-believe world to a world which is real money and real people, and it really matters to them. It doesn't matter whether Mrs. Jones has £250,000 or it's a Mr. A, another oligarch ex-KGB with 250 million. Okay, it all matters. And the conversations on a daily basis are actually, once you've got the trust, it's how did we end up in this state? How did we get here? And I put it and agreed on all sides, actually, in the way the market forces were created so that people got more and more, wanted more and more and more. We've now entered in an era as a consequence of 2008 that with the economies of the world the way they are now, and especially in the UK, is actually not being able to sit in there and offer a Bernie Madoff return of 20%. Funny how that didn't work. Where now it's about not losing people money, sustaining their wealth. The hunt for income, the hunt for yield is out there. We are going to flatline, at least, in my personal opinion, till about 2015. What does that mean to you guys sat on this thing? I'm getting to the end of my time. You're obviously all very bright. You wouldn't be, well, I'm hoping you are, otherwise you wouldn't be here bluffing it like me. So you're looking at a career. Never before has there been a greater opportunity for people with the right value set and the right behaviours to make an impact in finance. But you do have to demonstrate those behaviours. And you have to be able to be willing to work extremely hard and know that when you go to parties, you're more likely to say you're an estate agent than you are a banker, which is a bit of a struggle for some of us. Okay, so that is as a consequence, and you hear these, and Bob's absolutely right. My address book, which I like to think is rather large and extensive, has shrunk irrevocably in the last couple of years. But there's still room for talent. But you've got to no one's going to give it to you anymore. If I was having this conversation in 2003, I'd be at the door going, yeah, 2 arms, 2 legs degree, job done. Now, it's about proving that you have the core competencies. And one of those, and one of the key ones in all of that is integrity. Because clients can sniff you out a mile off. They don't want to be rinsed anymore. Okay, that is absolutely key. It's not a sexy job anymore. It's just not. If you want glamour and you want a bit of a high rolling lifestyle, probably finance in the UK is not it. Now I say in the UK, the emerging markets, some of them get rather upset that they're called emerging markets now. They're not. They've emerged and they own us. Be diverse, think broader, go into one of the newer markets and make your name there. But still be prepared for hard work and effort at every single level. But if you want to go for the UK, I encourage everybody to have a look at it. And the thing I do like about finance is that it is an incredibly diverse place to be, both in terms of nationality, age, grey hair. My clients like grey hair, so they tell me, because they think I've got as much to lose as them, which is absolutely true. And the diversity of roles. If I had £1 for every youngster, and I say youngster, every undergraduate or nearly postgraduate that said to me, I want to be a derivatives salesman, I want to be a derivatives trader, I'm going to be a private client manager, I wouldn't be sat here right now, I'd be in my Aston Martin going home, right? There are so many other things that you can do and use the skill sets. The big ones you're going to see and you're going to hear more and more: risk, regulation, compliance, legal. If I had my time again, I'd probably think about being a compliance officer. Because, as I was explaining outside, I have to carry 2 phones now. Regulation says that I can't text or do certain things from my work BlackBerry anymore, in case if there's insider dealing. All right? So there are some HR, operations, there are so many other things. And I do think that everyone thinks, oh, sales. Why give yourself that initial pressure of, for an example, a young postgraduate that I have in my team, I will expect him this year to write new business somewhere in the region of 50 million sterling. He very rarely sees his family. Okay, so it's all about putting it into context. I find 2008, the Queen called one of the years Annus Horribilis. 2008 was horrendous, so many friends move on. But I think now you're seeing an emergence of a new finance model. And the first thing we've got to do is actually win people's respect back and trust. The glory days of flaming sambucas, we do that rather quietly now, but you're not going to see that quite so obvious. But it is still a great career should you want to go down there. And I was really interested in David's comments, hence the diversity angle. It's don't think locally, think globally. So exactly as the orchestra did, right? So you've got to think global now. And if you don't follow what's going on globally, you're going to get left behind. I hope that's a bit of a taster, because there's another panelist here. And unfortunately, I do love the sound of my own voice. I have to talk for a living, right? So. But I also have to be at my desk at 7 in the morning, and I very rarely get home before 9, 10 o'clock at night. And I sit on the executive committee of a very large organisation. So I'm a bit of an extremist because I actually quite like hard work. I learned the lesson of being at university, and if I put half the effort I did at university, I'd probably have a doctorate by now, as I do in my work now. So it's there. You've just got to think about how you structure and you create that journey for yourself. And I will close with this comment. The journey from 2008 to 2009 has changed the landscape so that be open, be honest. You will be required to do that within your portfolios. Realise that many other roles within finance are more important than you are. And that the impossible, or that never going to happen, frequently does, as my communist strategy manager tells me every day, my Liverpudlian communist. And life in finance is not a motorway anymore. You're rarely going to find a 26-year-old. You might do. There's a few of them around, very small percentage, that have gone out and paid cash for a Maserati. Okay, unless they've got their own money, of course. Introduce them to me, I'll look after them. But you'll very rarely find that. It's not a motorway. There's going to be brakes on the way. There's going to be everything from an A road, B road, and a goat track. But you will, if you stay on the path, you will get to the destination at the end. So I hope that's a bit of a flavour, and I expect to be asked some particularly awkward questions at the end. And I wasn't an architect of deciding that UBS set up its but one of the biggest shocks, and I can remember it in September 2008, I was actually at home at the time, hadn't shaved for 2 weeks, and I received a phone call from one of my team who said, "Have I seen the news?" And I said, "I haven't read a paper or anything." I was painting my fence. To the complete shock and awe, because that's how I would term it in my world, having been on the other type of shock and awe during my career, of watching many of my friends go through a revolving door at 20 Bank Street. And for those of you that don't know what 20 Bank Street is, it was the bank formerly known as Lehman Brothers. I met Dick Fuld, and in the 45 minutes I had with him, I would have crawled across broken glass for that man. But he brought down a bank through his arrogance and intransigence and the danger that they were doing. 48 hours. It was horrendous. So it is a very deeply personal thing, the credit crisis. But we've got to learn the lessons. And you, as the next generation, learn the lessons and implement them. Because you're going to be earning our pensions in the future. You're the ones that have got to implement it. I'm doing it now, but I have a certain amount of shelf life. But if it's what you want to do, it's all very well having a crisis, but if you don't learn the lessons and implement the change, we've gained nothing. And the cycle, the Keynesian cycle, if you want to do it, will come back round again, and somebody else will be sat here in 20 years' time saying exactly the same thing to the next generation. In fact, it could be one of you. All right?
Indeed. So, let's find out. So, moving outside the UK, Eric.
Yes, thank you. Thank you for the opportunity to speak to you, to spek with you, hopefully later on. I will pick up on everything that all the speakers have said later on. But first of all, I want to mention that I also speak, of course, in my personal name, not in the name of my company. I'm not an economist. I'm actually also not an analyst. I'm not a retail banker, and I'm not an investment banker. But I did have the opportunity over the last 25 years to work with some of the world's largest companies in some of the world's most fascinating countries, including China, Korea, and now most recently in Ukraine, in the old Soviet bloc. And I can tell you that I'm actually very pleased and to some extent, I was going to use the word, I'm actually very proud of what I have seen and what I have done in the banking world. And if you remember anything of what I'm going to say tonight is what you also said, how you finished, Sean, is that think globally. Please remember that and explore countries. You don't necessarily need to live in all other countries in the world, but you think about the fact that other countries have a lot of opportunities, and this is where I want to pick up what David also said. Actually, of course, the news is not very good about the banking sector. Bob said that, yeah. But there are a lot of opportunities, and that's how I will structure my presentation today. I first will talk about why the situation in the banking sector is not very good at the moment. I will explain that in a little bit more detail, but then I will tell you what's also going on in the world. Yeah? And you will be fascinated to hear what is going on. And some of you, anyone from China here? Or? Yeah, so you may already know what I'm going to talk about, but it is most incredible what's going on in the world. Now, first of all, before 2008, what did we have? Actually, Sean was describing this. I think this means at that point that people would probably have said that we have very highly developed financial systems. That's what we probably were saying when you talk about derivatives, credit default swaps, etc. So highly developed. So highly developed is also a very relative term. You can have countries which don't have financially developed systems, and actually they also don't develop. And the country where we live now, in Ukraine, is actually an example of that. So you need a proper level of development in the financial system, otherwise you can't build your infrastructure. You can't build energy independence. You can't actually even allow people to buy houses, because if you can't do 20-year mortgages because you don't have liabilities on the other side of your balance sheet, then people can't buy houses, and the value of the house is meaningless because only people with cash can pay. Yeah. So you need a proper level of development, but of course, probably what we now say is that before 2008 it was too highly developed. There was very high liquidity in the system, and actually this means in banking terminology or in balance sheet terminology, this means that there was extremely high leverage in the system. High leverage means, how many of you know what high leverage means? Okay, quite a few. Then I can also say that at the moment when Royal Bank of Scotland was in deepest trouble, its equity was only about 1% of the total assets of the company. So that means very, very high leverage. Yeah. And that is not sustainable, because that means that a company does not have any buffer to sustain difficulties or to sustain actually, and that's going on, the reduction of asset values. Yeah. That's basically what you have. Reduction of asset values can happen in many different ways. If no one wants to buy your house, as I said, the house doesn't have any value. Yeah. But also, if you give someone a loan and he can't pay it back, that also means that you have a reduction of the value of your assets. So, highly developed, high leverage, high liquidity, and a wide and complex product range. But actually, that also meant that if you have high leverage, it means you have comparatively low equity, and comparatively high profitability means you have very high return on equity. Now, this picks up on what Bob was saying, the job losses in the city. This is, I will explain, the reason for that is actually relatively, it's not simple, but it's actually very tragic. But of course, what does new regulation mean? New regulation means that banks need to have more capital. They need to have more equity. Basel III says you need to have at least 7% of equity risk-weighted. So that's actually a complication of, it's not just a number, it's a calculation. We say this asset is risk-weighted at 100% and the other one at 50%, so we calibrate it a little bit. But anyway, we need more equity. Now this is a problem because we have lower profitability. And we have lower profitability because we don't sell all these silly products anymore. Yeah? I'm pointing to Sean because I never did, of course. But we don't have this. We were forced, because no one was buying these products anymore. The regulator didn't want us to sell them anymore. So we actually have lower profitability, frankly speaking. And banks are actually very difficult animals. You can't just move them. Yeah? You can't move your home market. My bank is based in the Netherlands, so I'm from Belgium. A Chinese bank cannot be moved. You can go and explore a little bit, like ICBC did 3 years ago. They opened 10 branches in Europe in the same day. But it's difficult to move banks. So you cannot move to markets where you can make more money overnight. It takes a lot of time. And anyway, we can't invest. So our profitability is under pressure. But at the same time, we need to raise more equity. So this is a problem, because if you don't have sufficient return on equity, if you're not profitable enough, you can't really attract more capital very easily. That's why most banks have only one solution, and they need to reduce their workforce. They need to cut the number of employees they have. And they're also, very unfortunately, cutting all the spending on, I was going to say charity, but I need to say on arts and culture. Yeah? Because, honestly speaking, it is impossible if I need to ask 10 people to leave in my office in 1 week, yeah, I cannot at the same time start sponsoring a Philharmonic orchestra. It's just not ethical. It's just not possible. Even if, technically speaking, of course, we have the money, you still can't do it. Yeah? So, very sorry. But the good news comes a little bit later. Yeah? So, after 2008, actually, this is now happening. And of course, this is very slow. It takes a lot of time. All the new regulations, all the new capital requirements, it's not very simple. Yeah? And I must also say that, of course, we all see that there is more regulation, but from the banking perspective, okay, maybe you don't think that all bankers are very smart, but frankly speaking, there are some very smart bankers, and we do have also concerns about more regulations. And what we also see is that global regulatory reform is conflicting with national agendas. So local governments also have their agenda. And therefore, unfortunately, banking is becoming more local. This is the result of not the capital requirements of Basel III, but the liquidity requirements of Basel III, where we talk about what we call matched funding. Yeah? And asset liability management, where we actually say we cannot lend money, you cannot move liquidity from one jurisdiction to another. Yeah? So you need to keep your money as a bank in the country as much as possible. That's what the local governments want. And then we need to match it as much as possible. So if we have a 20-year deposit, then we can do a 20-year mortgage loan. Yeah? And almost exactly the same number it should be. So we lose a lot of ability to be flexible in the way we lend money. This is actually happening. Yeah. Now, at this point, I must also say that there are not so many opportunities to lend money. It's very easy for people to say banks need to lend more money. We need more money in the system. We need to buy more houses. We need to buy more cars. We need to invest in more factories because we need more iPhones. We need more automobiles and etc. But of course, the big problem is in the world that there is overcapacity in almost everything. I think I actually don't have the exact number, but I read that only in Europe alone, there is excess automobile manufacturing capacity of 6 million cars. So why would we still spend money on building more factories to build cars? So you have to be realistic. Yeah? You have to be realistic. And if people can't afford to buy a house, if they don't have an income, a bank should also not lend money to this person to buy the house, because then you get incredible problems later on, especially at a time when assets are deflating, and that is a very terrible thing to happen in an economy. So it's not so simple. It's not so simple. But we see banking is becoming more local. And we don't think that's very good, because the rest of the world is actually becoming more global. Yeah? And I will talk about that later on. Yeah? Now, we should not forget that not only do we have excess capacity in almost everything, but we also have companies, large companies, who over the last, maybe Sean, you also know that, over the last 6 or 7 years have doubled their cash holdings. Yeah? So this is not funny. I mean to say, a banker to say that something is not funny, but this is actually a problem in itself. Because if they don't invest, why would we cannot lend them more money? They actually don't need the money. But they also don't see opportunities to go out and buy another large company or to invest in, again, the same topic, yet another car manufacturer. Yeah? So you need to see what's really happening in the world. And of course, China plays a very important role, but not only China, also Korea. And look at Japan with an incredibly high amount of excess capacity on almost everything they have.
On a deflationary economy.
On a deflationary economy. Reducing asset values is a terrible thing.
I think the current UK statistic is that companies are supposed to be holding 50% of gross domestic product in cash. And you'd think that that would kick in a mergers and acquisition bonanza.
But it doesn't.
But it hasn't.
And it's unlikely to happen because not all actually very few M&A transactions turn out to be good transactions. Okay. And that also moves into the cultural differences. But anyway, I want to focus a little bit on, I do need to say one more thing before I go to the good news. That is that banks actually, I don't know how many of you have been to Africa or so and have seen the development of the telecom. And actually today in the Economist there was a whole article on how the availability of mobile phones has completely changed the way people act, and that people try to hold on to their mobile phone much more than to food. This funny picture of someone very poor looking at a picture of food, of course that's typical Economist. But what I want to say is that telecom companies, retail companies, are actually playing an increasingly important role, especially in retail banking. Don't forget that. Yeah? So the role of banks also has changed. So that's 2008. Return on equity, I've already spoken about that. I hope that you remember that this is actually a really important point. We're in a management school, so we must assume that everyone understands that you cannot run an economy without capital, and you cannot run capital or equity without actually proving that you use your equity and your capital properly, so that you know how to make money on it. And this is what's happening in your world also, where companies are actually professionalizing their support of arts and culture. They actually have the money, but they need to be able to demonstrate that it brings something to them. So this is part of this big corporate cash holdings everywhere. Now, I have my own PowerPoint, and I called it Meanwhile in Asia. You know, this was the slide, Meanwhile in Asia. How many of you have been to Asia? Yeah, almost, just quite a good group. Yeah. Now, let me first start by saying that the foreign exchange reserves in the world have increased from $2 trillion in 2000 to $12 trillion in 2012. These are official data, you can just Google it. Yeah? So it's just 6 times increase over 10 to 12 years. Now, Asia now constitutes 52% of the world's foreign exchange reserves. Not all of you need to know the definition of foreign exchange reserves, what's included and what's excluded, but anyway, it's one of these very important measures to calculate or to actually see whether a country is doing well and whether you have sustainability for your trade and all that. Now, Asia 52%, and China, do you know how much? Sorry? Well, of the world, it's 25%. Yeah? But they have $3.3 trillion, which is 25% of the world's total. Yeah? And now the top 10 in the world includes 7 Asian countries of the highest level of foreign exchange reserves. Yeah? So please don't forget. So if you're on your next trip, yeah, I suggest you go to Singapore or so, which is actually a AAA country, as you know. Yeah? Oh yeah, sorry, I'm distracted a bit. Foreign exchange reserves, Standard & Poor's, yeah, over the last 6 months have upgraded 4 Asian countries. And you will not expect which ones. Yeah? It's Korea. Actually, I know Korea very well. We lived there for more than total 5 or 6 years, maybe 6 or 7 years. So Korea is an absolute miracle. Yeah? I will talk about it a little bit later on. Upgraded Korea, Pakistan, Philippines, and Vietnam. India is the only country which was downgraded over the last 6 months, because there is actually, people were expecting much more to happen in India, but political reasons, it's all moving very slowly. So it's not doing as well as people were expecting. Now, Asia has now 3 countries with a AAA rating, including Australia. Sometimes, and in my bank we also say Asia excluding Australia, but actually we also say excluding Japan. So that's it's a bit difficult to say what exactly Asia is. But Australia, Hong Kong, and Singapore are AAA countries. Don't forget. Yeah. Now, the top 10 of AAA countries, let's not be too pessimistic about Europe. Top 10 of AAA countries is still mostly Europe, with, I think, 6 European countries are still AAA at this point. Now, so there is actually quite a lot of good news in the global financial system. And I go a little bit deeper, talking about banks in Asia. Now, in Asia, you see, I still say we in Asia, but because we lived there for so long, we say highly developed, Australia, Singapore, Japan, then Greater China. Unfortunately, in Greater China, the leverage is actually increasing, so comparatively speaking, the equity of the banks is shrinking because of asset values are actually increasing there most of the time, and the non-performing loans are increasing also in Greater China. So that's quite a big problem. Not a big problem, but it is a new problem. Let's put it like that. When we moved to China in 2000, actually everyone was talking about the coming collapse of the Chinese banks, and people were saying they don't have equity. How can you be a bank without equity? Without solvency, they were all technically insolvent because they had very high non-performing loans. But of course, maybe you learned that in the management school or in finance, that it is not solvency or absence of solvency that kills a company, but absence of liquidity. And all Chinese people are very, very big savers. They never leave the table without taking a doggy bag home. So they're incredible savers, and the whole Chinese banking system continued to be actually very, very liquid, highly liquid, and nothing happened, and they're still there. So, and they're actually now, I have the numbers. In the top 20 of the world, we now have 4 Chinese banks. 10 years ago, they were not even there. So 4, ICBC is number 4, China Construction Bank is number 11, Bank of China 13, and Agricultural Bank of China is number 15. So all incredibly big banks, with millions of people employed. You can't even begin to think what it means. So you have highly developed Greater China emerging markets, Korea, India, Indonesia. Indonesia, don't forget, has 240 million people. An average growth rate between 6 to 8% over the last 10 years. So don't, as George Bush said, don't underestimate them. And then you have the rest of emerging markets with Vietnam, Laos, and Myanmar. Overall, since 2008, the banks in Asia have remained strong, and they have actually expanded. And some of them, mostly the Singaporeans and Hong Kong banks, have become regional players. And some of the Chinese banks are trying to become international players, but it's not going it's not very easy. But anyway, they're trying, and they have all the money in the world. Something about China. Do I have 2 more minutes?
A couple more minutes.
What, sorry? What?
1 more minutes.
2 more. IPOs, you know what an IPO is? Anyone who doesn't know? An IPO is an initial public listing on the stock exchange. Who do you think, which country do you think was the largest over the last 2 years? China, by far the largest, with $45 billion raised in 2011. Very important, internationalization of the renminbi. Don't underestimate the importance of this opening up of the Chinese currency. Trade, this was a totally non-convertible currency even 5 years ago. Now you can go into a Louis Vuitton shop in Hong Kong, and I think even in Paris, have you tried to buy a bag and pay cash in Chinese currency? You haven't tried?
Yeah.
You're still a student. Huh? Yes, you see. But you can only buy one bag with one passport, right?
Yeah, why is that?
Sorry?
Why is that?
Do you know?
Because a lot of Chinese tourists will tend to come to here because taxation is not
Yes.
high in China.
Yes.
But back in the system here, it's a lot cheaper compared to
Yes.
A lot cheaper.
A lot cheaper. And they don't have enough supply, honestly
And
speaking.
that is why London is pitching to become the centre for renminbi trading.
Yes. Which is
It makes
unbelievable.
sense. And of course Deutsche loves it because we look after 27% of the world's FX trading on a daily basis. Of course we're encouraging this muchly.
Mr. Chairman, I can say a lot more. I can say a lot more about China, but I do need to say something about Eastern Europe, which is where I live now, yeah? And which is also very important for you, David, yeah? Because you know the biggest property investors in London these days are.
I was pipped yesterday. It was
Sorry?
pipped yesterday.
Oh.
The South Africans are number one. Yes.
Oh, the South Africans.
Yes,
so
changed
my
yesterday.
information is.
But I know what you're
updated.
about to say, and a new. So I did enjoy walking around the office to a chap that only deals with Ukrainians and Russians.
Yeah, Ukrainians.
And said to him, "Best you learn a bit of Afrikaans now." So yeah.
So the problem in these countries is that there is an incredible concentration of wealth with a small number of very, very rich oligarchs, yeah, who happen to be in the right position, in the right place, in the right connections when all the privatizations, so-called privatizations, took place about 20 years ago. So this is where the wealth comes from. Yeah? But it's massive, and they like to show it. Yeah? And they actually also. The combination in what you said, David, about Moscow, same we have in Ukraine, in Kiev, with a very, very rich and lively art and culture life. Yeah? Every day there is something new in the opera. Yeah? It's not like 6 months the same. It's every day something new. So the combination of concentration of very, very high wealth, very showy societies, and a very strong interest in culture is actually also a very interesting target audience for yourself. That's all I have to say today.
Thank you. Thank you to all three of you. Questions? Do we have a microphone?
We do have a microphone.
But do we need it?
I don't know.
I'm not sure. Well, let's take a question. If we can hear you, probably don't need a question.
I think we have 2 questions on the sheet of paper as well.
Are those from individuals?
Yeah, but they would prefer them to be read out.
Well, I might go to them, but let's take a couple from the floor first.
I'm interested in my careers consultant here at Holloway. I'm interested in what you were saying about the sort of change in competency, change in values in people. So I don't think coming to me and certainly I want to be in banking. How do you define really what the core competencies are that the students really need to have? And how can they come to
That's a good question.
Yeah, that might be a bottle of claret and some canapes later. I'll try and keep it core competencies. You've got to be adaptable, hardworking, bright, be able to embrace change. And I can actually get it down to 3 key areas. You've got to analyse an issue. You've then got to be able to plan around it and then execute. You get lots of people that suffer paralysis by analysis. You get lots of people that can write a very nice plan. And you can get some complete buffoons who generally end up working for some very successful companies because they are execution mad. But they have absolutely no emotional intelligence whatsoever. If you, at the School of Management, and the students that you see, can combine the 3, you've got the package, right? But you've got to combine that with You know, gone are the days of having an extremely high IQ and treating people badly. You have to engage your emotional intelligence as well. And I think HR departments are seeing more and more of it. And actually, be normal. We did a bench test with our 300 interns this summer, where I have a colleague who is slightly odd and lives in Guildford, actually, who said, right, has anyone ever sold an ice cream in this room? Has anyone had a paper round? Silence. Has anyone worked in a shoe shop or in a supermarket? Silence. Then he said, okay, who's done a previous summer internship at a private equity firm? 50% of the hands went up. Who can play the piano at almost concert level? Nearly all the hands went up. So what people think that you have to be, you've got to be yourselves. Be yourself. So don't try and hide the fact that you didn't have a paper round or you worked in a supermarket, because actually it gives you the ability to talk to people normally. And I think so often people have got in this thing, I have to have, my first year summer has to be at an investment bank. My second year internship has to be at a private bank. My third year. And they forget, actually, and I loved the whole piece about ING, because the thing that's kept us all going is actually the retail banks. And for years, investment banks have looked down on private banks who have looked down on retail banks. Without the money in the retail banks and retail bankers, the investment banks would have ceased. So they don't like us very much. But having been an investment bank, it's hilarious being on the other side of the fence. So they need our real money, real people, hence the whole thing of segregation inside it. So does that answer your question? And sort of, well, I can expand it later if you.
Question down here.
You just talked about using up you talked about the investment banks being supported by the retail banks, and I was wondering what your opinion, because you were talking about compliance and changing regulations, and there's been talk of like a possible UK Glass-Steagall Act, whether it's the investment banks and the retail banks. I was wondering, do you think that would promote this changing values that you're talking about, or do you think that would harm them because they wouldn't be able to, there wouldn't be that communication of skills and moving people? Do you think that would be beneficial?
It sounds like an essay question to me. It sounds like an essay question. Yeah, it's a very good, very good question. And again, I think we could go on for quite a while about it. Personally,
I'm happy it's a UK-based question. I'm happy it's a UK-based question.
Yeah, it is very UK. I mean, our new co-chair went on and said that Europe needed banking union. That went on record the other day. Personally, very, very difficult to answer that question. Actually, I'm going to have to think about that. Can I come back to you on that one? Is that all right? Because there are all sorts of ramifications on either side. Good and bad.
Other question?
You look like you want to ask one.
Self-regulation, you mean?
Yeah, kind of internal dialogue and like you're saying, encouraging different values and behaviours.
Well, personally, I do not necessarily think that more regulation, more external regulation is the solution. You can have, I think, maybe you know this better than I do, but in the the typical example is that the US is has the highest number of criminalized acts in society, you know, but actually also the highest number of people in prison. So does that, I think the correlation is a very interesting academic topic, but as Sean also says, it's about how you do it yourself and how you act. And of course, I've worked in my bank, as I said, not in investment banking and not in derivatives products, but we all see people who only want to do a deal, you know? And I think that is the problem. And we all need to try and step up a little bit and see what is the ultimate benefit and the ultimate goal of doing business as a bank. And we sometimes simplify that in our compliance trainings. We say, you want to deal with someone who doesn't have the right ethics? Do you want your chairman to be on the cover of the newspaper with this person, shaking hands? And do you want to disclose a transaction that you've done selling terrible credit default swaps? Do you want to talk about it with your grandmother? Simple things like that, we believe in our bank, are more relevant than having more regulation, because more regulation you can always, I'm not saying we don't need regulation, don't quote me on that, but it's not enough to have boxes and tick the box and
that's
not
a
enough.
key point.
That's what you were saying.
Do not make it a tick box exercise.